There are several strategies out there for investing for success. Some require advanced knowledge and really good technical chops to execute them efficiently and effectively. This video is not about one of them. Let's go over investing strategies and secrets for ETFs in today's video. What's up, everybody? Welcome to BTP Fusion. I'm your lovable host, Derek West. If this is your first time here, welcome. I know you'll love the tips, tricks, and topics that we cover. If you're coming back, welcome back. You know how we do it here. Let's dive right in. To really dive into the strategies and secrets of investing with a certain instrument, you really should know what the heck it is you're dealing with. In this case, ETFs. An exchange-traded fund, heretofore known as ETF, is a type of security that involves a collection of securities, such as stocks, that often tracks an underlying index. Although they can invest in any number of industry sectors or use various strategies. ETFs in many ways are similar to mutual funds. However, they are listed on exchanges, and ETF shares trade throughout the day just like ordinary stock. Some well-known examples in the investment world are the SPDR S&P 500 ETF, or SPY, which tracks the S&P 500 index. ETFs can contain many types of investments, including stocks, commodities, bonds, or a mixture of investment types. An exchange-traded fund is a marketable security, meaning it has an associated price that allows it to be easily bought and sold during trading hours, which helps to distinguish it from mutual funds that track indexes. Index funds for short. In fact, that's the reason why it's called an exchange-traded fund. It's actually traded on an exchange, just like a stock. An ETF is a type of fund that holds multiple underlying assets, rather than only one like a stock. Because there are multiple assets within an ETF, they can be a popular choice for diversification. An ETF can own hundreds or thousands of stocks across various industries, or it can be isolated to one particular industry or sector. Some funds focus on only US offerings, while others have a global outlook. For example, bank-focused ETFs would contain stocks of various banks across the industry. There are various types of ETFs available to investors that can be used for income generation, speculation, price increases, and to hedge or partially offset risk in an investor's portfolio. Bond ETFs might include government bonds, corporate bonds, and state and local bonds, colloquially described as munis. Industry ETFs track a particular industry such as technology, banking, or the oil and gas sectors. Commodity ETFs invest in commodities, including crude oil or gold. Currency ETFs invest in foreign currencies, such as the euro or Canadian dollar. Inverse ETFs attempt to earn gains. Gains. Not those kind of gains. Money gains, fiduciary gains, financial gains. Inverse ETFs attempt to earn these gains from stock declines by shorting the stocks. Now, quick primer. Shorting is selling a stock, expecting a decline in value, and repurchasing it at a lower price. ETFs, like index funds, are ideal for beginning investors because of a couple of reasons. Namely, their lower expense ratios. ETFs, which are passively managed, have lower expense ratios compared to actively managed funds, which mutual funds tend to be. What drives up a mutual fund's expense ratio? Costs such as management fees, shareholders and accounting expenses, service fees like marketing, paying a board of directors, and load fees for sale and distribution. ETFs also enjoy abundant liquidity. Unlike index funds, although the ETF might give the holder the benefit of diversification, it has the trading liquidity of an equity. ETFs can be purchased on margin and sold short. ETFs trade at a price that is updated throughout the day. An open-ended mutual fund, on the other hand, is priced at the end of the day at the net asset value, or NAV. ETFs also allow you to manage the risks by trading futures and options, just like a stock. Because ETFs trade like a stock, you can quickly look up the approximate daily price change using its ticker symbol and compare it to its indexed sector or commodity. Many stock websites also have better interfaces for manipulating charts than commodity websites, and even provide applications for your mobile devices. Another benefit for owning ETFs: you can immediately reinvest dividends. The dividends of the companies in open-ended ETFs are reinvested immediately, whereas the exact timing for a reinvestment can vary for index mutual funds. Limited capital gains tax, another benefit of owning ETFs. ETFs can be more tax efficient than mutual funds. As passively managed portfolios, ETFs and index funds tend to realize fewer capital gains than actively managed funds. Also, when an ETF buys or sells shares, it's considered an in-kind redemption and does not result in a tax charge or a taxable event. Mutual funds, on the other hand, are required to distribute capital gains to shareholders if the manager sells securities for a profit. This distribution amount is made according to the proportion of the holder's investment and is taxable. If other mutual fund holders sell before the date of record, the remaining holders divide up the capital gains and thus pay taxes, even if the fund overall went down in value. Now, that said, it isn't all sunshine and rainbows, unfortunately. ETFs have their disadvantages. Some might say that they're less diverse. For some sectors or foreign stocks, investors might be limited to large cap stocks due to a narrow group of equities in the market index. A lack of exposure to mid and small cap companies could leave potential growth opportunities out of reach for ETF investors. Another downside, intraday pricing. The fact that an index fund or the fact that an ETF can be priced throughout the day might be overkill, particularly for long-term investors. Long-term investors typically have an investment horizon of about 10 to 15 years, so the intraday pricing is not necessarily a benefit for them. Another downside is that some investors may trade more due to these lagged swings in hourly prices. A high swing over a couple of hours could induce a trade whereas pricing at the end of the day could keep irrational fears from distorting an investment objective. In other words, the intraday pricing of ETFs kind of encourages the bad habits that a lot of people pick up when they begin to invest stocks. In other words, when stock drops a lot in value, they sell. And when they see a stock going up in value, they buy. Buying low and selling high, which is the exact opposite of what you want to do when you're investing. Some people think that the costs could be higher. Most people compare trading ETFs with trading other funds. But if you compare ETFs to investing in a specific stock, then the costs could be higher. The actual commissions paid to the broker might be the same, but there is no management fee for a stock. Also, as more niche ETFs are created, they are more likely to follow a low volume index. This could result in a high bid/ask spread. You might find a better price investing in the actual stocks. ETFs are also known to have lower dividend yields. There are dividend-paying ETFs, but the yields may not be as high as owning a high-yielding stock or group of stocks. The risks associated with owning ETFs are usually lower, but if an investor can take on the risk, then the dividend yields of stocks can be much higher. While you can pick the stock with the highest dividend yield, ETFs track at a broader market. So the overall yield will average out, typically, to be lower. Another downside is that some returns from leveraged ETFs can be skewed. Now, quick primer, a leveraged ETF is a fund that uses financial derivatives and debt to amplify the returns of an underlying index. Certain double or triple leverage ETFs can lose more than double or triple the tracked index. These type of speculative investments need to be carefully evaluated. If the ETF is held for a long time, the actual loss could multiply fast. In cases like this, it's typically easier just to keep it simple and not to invest in really exotic types of instruments. With those things in mind, what strategies can you execute to ensure you profit from owning exchange-traded funds? Dollar cost averaging. We begin with the most basic strategy, i.e. dollar cost averaging. Dollar cost averaging is the technique of buying a certain fixed dollar amount of an asset on a regular schedule, regardless of the changing cost of the asset. Beginning investors are typically young people, millennials and Gen Zers, who have been in the workforce for a year or two and have a stable income from which they're able to save a little each month. In that instance, you should take a few $100s every month and instead of placing it into a low interest savings account, invest it instead into an ETF or group of ETFs. There are two major advantages of such periodic investing for beginners. The first is that it kind of encourages a certain discipline for the saving process. As many financial planners recommend, it makes a ton of sense to pay yourself first. You do this by saving regularly. The second benefit is that by investing the same fixed dollar amount in an ETF every month, the basic premise for dollar cost averaging, you will accumulate more units when the ETF price is lower and fewer units when the ETF price is high, thus averaging out the cost of your holdings. Over time, this approach can pay off handsomely as long as you stick to the discipline. Another strategy, asset allocation. Asset allocation simply means allocating a portion of your portfolio to different asset categories such as stocks, bonds, commodities, and cash for the purposes of diversification. It is a powerful investment tool. The low investment threshold for most ETFs, generally as little as $50 per month, makes it easy for a beginner to implement a basic asset allocation strategy depending on his or her investment time horizon and risk tolerance. Quick example, a millennial or Gen Z investor may be 100% invested in equity ETFs when they're in their 20s because of their long-term investment horizons and or high risk tolerance. But as they get into the 30s, like yours truly, and embark on a major life cycle change such as starting a family and buying a house, they may shift to less aggressive investment mixes, such as 60% in equity ETFs and 40% in bond ETFs. Another ETF investment strategy, swing trading. Swing traders are traders that seek to take advantage of sizable swings in stocks or other instruments, like currencies or commodities. They can take anywhere from a few days to a few weeks to work out. Unlike day trades, which are seldom left open overnight, the attributes of ETFs that make them suitable for swing trading are their diversification and tight bid/ask spreads. In addition to that, because ETFs are available for many different investment classes and a wide range of sectors, a beginner can choose to trade an ETF that is based on a sector or asset class where he or she has some specific expertise or knowledge. Another example for you, someone with a technology background may have an advantage in trading a technology ETF like Invesco, which tracks the NASDAQ 100. A novice trader who closely tracks the commodity markets may prefer to trade one of the many commodity ETFs available. Because ETFs are typically baskets of stocks or other assets, they may not exhibit the same degree of upward price movement as a single stock in a bull market. It's one of the downsides of owning ETFs. But by the same token, their diversification also makes them less susceptible than single stocks to a big downward move. This provides some protection against capital erosion, which is an important consideration for beginners. Another strategy that people often utilize when trading ETFs, sector rotation. ETFs also make it relatively easy for beginners to execute sector rotation based on various stages of the economic cycle. Another strategy, short selling. Short selling is the sale of a borrowed security or financial instrument. It is typically a pretty risky endeavor for most investors and really something that a beginner wouldn't want to attempt. That said, short selling through ETFs is preferable to shorting individual stocks because of the lower risk of a short squeeze. That's a scenario in which a security or commodity has been heavily shorted, spikes higher, or the price spikes higher, thus leaving you holding the bag. It's also less risky because of the significantly lower cost of borrowing, compared with the cost incurred in trying to short a stock. If you want to get into short selling at all, I wouldn't recommend it, but people do it, and if you're going to do it, the less risky way with ETFs is probably the way to go. Short selling in and of itself is quite the topic. I'm going to dive into a little bit more in a future video. Be sure to stay locked in, like and subscribe on this video, and don't forget to click the notification bell. So those are several strategies for beginners in ETFs to try and execute. Let us know what you think in the comments down below, and don't forget to like and subscribe and click the notification bell for more great content from BTP Fusion.